On today's show, what advisors need to know about the index annuity product market. Part 5 of this week's series on index annuities with nationally recognized annuity expert Mike McGlothlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and Innsmouth. Let's get down to business. Welcome, Mike, day 5. We have been going through the basic foundations of indexed annuities, and I have to say, just my favorite so far, yesterday's show, if you need to go out and watch this, actually I would say watch it from the beginning so that you can see the progressive education. It's kind of a learning curve and want you to enjoy your tutorial experience. Today we're going to talk about we're going to actually name some names here and talk about the market. When I talk about the market, it has changed so much since back in the day 10 years ago. I mean, it's really changed. The players, the names, there's nobody that I'm aware of that was number one 10 years ago and now is still a top player. I mean, everybody seems to switch out because we become more efficient and more effective. Our construction of these contracts have begun really good for the consumer. So let's walk through some of these. Tell me, let's just start with the Allianz 360. Why are you in love with this product?
Well, one, I think that all the Allianz products offer a very unique income rider, and for the vast majority, clients are wanting this type of product for long-term retirement income. Gives you the opportunity for increasing income, which when you think of all the healthcare costs and inflation, people are trying to retire younger, but more importantly, we have greater longevity than we did just 10 years ago. You know, better medications, better lifestyles, we're living longer. The impact of inflation will catch up with a lot of people, and that's why we like the Allianz product. The other factor in there is their largest growth has come from the Barclays dynamic hedging inside of there. It's an uncapped strategy, getting a lot of play in the broker-dealer community as well as the independent space.
Yeah, still has a spread to it though.
Still has a spread.
Sure. Okay, and you like that. In their core income 7, is there a distinguishing difference between that secondary product, that signature 7? Is there a real difference there?
Rider cost embedded in there.
But that's it.
Yeah.
Okay,
but I mean, and really, when we talked earlier in the week about the increase in the broker-dealer market, these products were really meant to be for the broker-dealer market.
So registered reps really have a handle on this.
Yeah.
We'll talk about Genworth's Secure Living Index 7. That's another one.
You know what we like about this product is, again, from a client-centric standpoint, offers a bailout. So we talked earlier in the week about the quality of the renewal rate. Looking back at the history, one thing you don't have to take a look back with some of these carriers that have bailout is that they're putting their money where their mouth is. If they pierce that bailout, whether it be 50 basis points lower or 200 basis points lower than the original rate, that contract becomes completely liquid and the client can walk and go to somewhere else if they choose to do so. Wow. So those carriers are putting their money where their mouth is about the integrity of their pricing, their consistency of the pricing, the ability to manage their bond portfolio.
That has to be popular. You're giving the consumer a out, and I really like when a carrier puts their money where their mouth is, like you said, because that to me is a huge consumer plus.
Yep.
Talk about Great American. I've noticed these guys, I didn't really remember them 10 years back. Now they're kind of a player.
Yeah, Great American is a player. They're number 1 in the bank channel, number 1 or number 2 historically. They have just revamped their pricing on their riders so that they are back to their 10% simple for 10 years. So you automatically double your income value over the course of a 10-year period.
Any charge for that?
Yeah, there's a charge of that. You can do a combination of a death benefit. So a lot of different pricing options within that based upon the client need. On the safe return product, don't forget that they also have a complete bailout and liquidity there from a pricing standpoint.
So the pricing doesn't go the way we thought it was. This carrier and both Genworth and Great American are going to let the client out without a surrender charge. That's what I'm hearing. Without a surrender charge and no ding to the cash account.
Correct.
But I love that. And when we talk about that, do you see advisors perk up? And when you talk, they like that?
Yeah, because think about the client that's buying a fixed indexed annuity. It's not your equity investor for the most part, maybe to rebalance some portfolio, but the large majority of people buying fixed indexed annuities are those people that want safe, consistent, and some type of guaranteed type of return. In other words, guaranteed return of their principal. So that typical CD buyer may not be comfortable with locking into a 10-year surrender charge, but if he or she knows that he can get out if pricing goes south on him, then that makes that sale a lot easier and much more client-centric for the client.
I can only see that the registered rep market would just love something like this.
Yeah.
We come back from the break. I want to look at about 3 to 4 more carriers that we're looking at that we think are players in this market. We'll be right back, right after the commercial. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. I'm with Mike McGlothlin, annuity expert. You know, Mike, you recognize I see a lot of your articles, same place I write, Producers Web, other places on the web, and we don't usually get too involved in the specific carrier picks like we're doing today. But I think I get this out all the time. Steve, who are the players? Who gives us the benefit? Those last two that we talked in that segment, those two bailouts. Huge provision. Let's talk about another great American product. I hate to bring up 2 and 7, but they're a player. American Legend 3. What's that about?
Well, again, I think that when you're taking a look at bank or registered rep advisors, it's only a 7-year surrender charge, so it's very, very friendly from a broker-dealer community. They've made some enhancements to the American Legend 3, and will continue to make some in terms of the crediting strategies as well as the time frame. They have an 18-month time frame instead of an annual point-to-point, so you might want to try to ladder something out. Then there's also some commodity indices in there with the gold index.
That sounded a little bit unique to me. 18 months.
It is unique, yeah. 18 months and also a gold index is fairly unique.
Yeah, I don't know how gold's doing right now, but
yeah.
What about Reliance Standard, the Keystone 5 product?
Yeah. Reliance Standard is a great company, highly rated, again, sells really well in a bank environment, but when you're looking at trying to pick up assets for that CD mentality client, they typically do not like to go out to the 7 or 10-year surrender charge. So this is a great opportunity to hook them up to an index, have some type of equity type of growth above 0.25% in a bank CD, and have opportunity for more. So we really like this company, good strong company, no capacity issues, and great service on all these companies that we talk about.
Now on a 5-year platform like that, what's the surrender like then?
Varies by state, but really your most common is 5, 4, 3, 2, 1 or 7, 5.
Any roll-ups involved in this? Because it's kind of short and maybe it'd be roll-up happy. Are you allowed to do that?
Yeah, there are some roll-ups on some short-term surrenders as well. Carriers actually like that because when you're really locking into a 10-year roll-up, regardless of whether it's a 5, 7, or 10-year surrender charge, that client really has that mentality of, I'm holding this for 10 years. Now, having said that, we illustrate 10-year roll-ups all the time, and I can tell you that the industry illustrates 10 years, but our average election rate right now is about 2.5 years.
In a short-term place, I think, didn't you say, and I'm just reading from my notes, there's an Allianz product that's unique like this because it's based solely on the account value plus the possible bonus on the 360?
Yeah.
That kind of plays into this, right?
Yeah. The way that works, and again, I think when you take a look at the annuity industry as a whole, we're seeing a lot of investment-only variable annuities, and then we're also seeing some variable annuity income riders based upon the account value. And I think that that's probably the trend in the future. When you take a look at 5 years in the future, you've got some guaranteed roll-ups and some potential downsides and market corrections. Who knows what carriers are going to do if they experience anything remotely similar to 2008 and 2009. So from an Allianz product standpoint, they base everything off the account value. Let's say that your account value grows by 4% in 1 year. Then they're going to give a 25% bonus, so another extra 1% for the account value, for the income value. So basically, your income value grew at 5% and your account value grew at 4%.
Is that a contractual provision?
Yes, it is.
Wow, I think that's a huge option. Do you see many people choosing this because of that?
Yeah, because they can,
right.
You know, again, if you have a uncapped index over the spread, and you have a 7% net return, you're going to get 25% interest credit on that for your income value. That becomes a powerful story especially if you defer that for 10 years down the road.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always check your tax advisor, legal counsel, and your broker-dealer compliance officer. Missed an episode? Just hop out to our site, downtobusiness.ashbrokerage.com. Want to contact me? Steve@downtobusiness.tv. And remember, you could be wiser as an Ash Brokerage advisor. We'll see you next week.